So we're seeing a very interesting close to this week as we've seen global bond yields surging higher, and the immediate fallout there has been a very weak yen, with the Bank of Japan recently having established this yield curve control policy with the longer yields fixed at around 0% for the 10-year. It means that any expansion yields or rise in yields elsewhere expands the yield spreads and works against the yen's favor. So we're seeing dollar yen breaking higher. An interesting development that could really get going at full steam next week if we see a strong batch of U.S. data. After all, next week we're seeing this normal first week of the month batch of U.S. data, which is all key as we look towards that potential December rate hike. Now the question is, of course, we have a presidential election up on November 8th, about 10 days away. And that means that it's hard to judge whether the market is willing to commit capital to trades ahead of that event. But I think the dollar does look like it's trying to establish a broader rally here, and positive data I think is going to underline that. Do see some volatility risks around the U.S. election, but let's not worry about that. Let's take one step at a time. Consider these rise in bond yields and a rise in the dollar as being strong for the dollar, weak for the yen, and should be as well weak for these risk, sort of traditional risk on currencies that are sensitive to yield because of the sensitivity to carry trading. So commodity dollars, emerging market currencies could be the weakest currencies versus the US dollar if risk appetite is impacted by this. As well, we have three central bank meetings next week. I'm not expecting anything from any of these three: Bank of Japan, RBA, and Bank of England. The Bank of England one probably the most anticipated because there was noise in previous rhetoric that they might cut rates. I think a rate cut might be off the table with the recent inflation data and the sort of pushback against further softening in monetary policy when we have inflation, and the understanding that the exchange rate is important for the Bank of England at some level. So I think the Bank of England skips a rate cut this time around, and we could see some reaction around that. But all this, of course, in the context of the year's premier event risk, that U.S. presidential election on November 8th.